Welcome to the Radio Revenue Podcast. So, usually when we think about the grocery store, we just think of it as this perfectly static, comforting environment.
Right, exactly. It's just where you get your food.
Yeah, you walk down the cereal aisle or, the baking aisle, and the brands looking back at you, the Cheerios, the Betty Crocker, Pillsbury, they just feel like they've been there forever.
Mm-hmm.
It feels stable, almost inevitable. But today, well, we're going to completely shatter that illusion for you.
We really have to, because behind those brightly colored boxes is a boardroom maneuvering through some truly turbulent financial waters.
Oh, yeah.
The grocery aisle is not a comforting pantry. It is an active, frankly brutal battlefield for margins.
Yeah, and our mission today in this deep dive is to decode the fiscal year 2026 Form 10K for a 160-year-old titan of that very battlefield. We're talking about General Mills.
Right, General Mills.
Because this isn't just a list of cereal brands. What we have here, in these 140-plus pages of SEC filings, is a real-time look at how a massive multinational corporation navigates a squeezed consumer base, relentless inflation, and a food landscape that is just changing at breakneck speed.
Yeah, to set the baseline for you, General Mills pulled in $18.4 billion in net sales for fiscal 2026.
Which is a massive number.
It sounds astronomical, and obviously it is. But, in corporate finance, context is everything. That $18.4 billion, it actually represents a 5% drop from the previous year.
Wow.
Yeah, and when you are operating at an $18 million scale, a 5% drop means nearly $1 billion in revenue simply vanished.
Just gone. And honestly, that revenue drop is just the tip of the iceberg here.
It really is.
Because today we're going to explore why a company famous for human food, things like yogurt and Haagen-Dazs, just dumped its United States yogurt business to buy premium dog and cat food.
Which is a wild pivot.
Right. And even more shockingly, we're going to figure out why their operating profit took a jaw-dropping 73% hit this year.
It is a massive recalibration. I mean, we are watching a legacy company fundamentally reshape its portfolio in real time. They are taking some incredibly painful accounting hits right now to set up a totally different future.
Okay, let's unpack this. Because going from the big picture revenue drop, we have to zoom immediately into the most shocking number in this entire document.
The operating profit?
Yes, the operating profit. It plummeted 73%. Down to $886 million.
Yeah.
Now, for a company of this scale, a 73% drop sounds like, the alarms are blaring, the ship is sinking, and people are scrambling for the lifeboats.
It absolutely looks catastrophic on the surface.
Yeah.
But we really have to separate the boardroom accounting from the day-to-day factory operations here.
Okay, how so?
Well, this is where the distinction between reported profit and adjusted operating profit becomes critical. If you only read the headline reported number, yes, operating profit fell off a cliff to $886 million.
Right.
But the adjusted operating profit tells a very different story.
And the adjusted number, that strips out the one-time infrequent accounting events, right? Like, it shows us how the actual business of selling cereal and snacks is doing day to day.
Precisely. And when you look at that adjusted operating profit, it only decreased 16% on a constant currency basis. It landed at a much healthier $2.8 billion.
Okay, wait, before we move on, let's clarify that term for the listener. Constant currency basis, that just means they're stripping out the effects of foreign exchange rates, correct?
Likely.
Like if they sell 1 million boxes of cereal in Europe, but the euro weakens against the dollar, their revenue looks lower on paper, even though they sold the exact same amount of physical food.
That is the exact mechanism. Constant currency lets us look at the actual operational volume, just without the noise of global currency markets.
Got it.
So operationally, they're down 16%. I mean, it is still a notable drop, sure, but it's not a panic in the streets scenario.
Okay, so what exactly dragged that reported number down so violently then? If the everyday business is still generating $2.8 billion, where did the rest of the money go to drag the final number all the way down to $886 million?
Well, it didn't actually go anywhere, not in a literal cash sense.
What do you mean?
The 73% drop is driven by massive non-cash impairment charges. Essentially, General Mills had to admit on paper that certain assets they own are no longer worth what they originally modeled. And the biggest piece of this puzzle is a staggering $1.5 billion goodwill impairment for their North America pet reporting unit.
Okay, let me make sure I'm visualizing this correctly. Goodwill is essentially the premium a company pays when they acquire another business.
Sorry,
Like you look at a pet food company's factories and inventory, say it's worth $1 billion, but you pay $2.5 billion because you expect that brand to grow massively in the future.
That is the exact corporate mechanism. You are paying upfront for the future growth and the brand loyalty.
So taking a $1.5 billion goodwill impairment means they're essentially admitting, oops, that premium we paid was way too high. The growth just isn't happening.
Basically, yeah.
It sounds like you're doing a massive spring cleaning of their financial pantry, like throwing out the expired cans and taking the pain now so the shelves will look better for next year. But is it just paper losses? It's like taking an expensive painting to the Antiques Roadshow, only to be told the masterpiece you bought for $1 million is just a nice reproduction worth a fraction of that.
That is a great way to look at it. And what's fascinating here is, well, while these are technically non-cash charges, meaning General Mills didn't write a $1.5 billion check to anyone this year, they reflect a sobering, very real shift in reality. An impairment means the future sales and profitability projections for these specific assets are definitively lower than General Mills initially projected. They expected a certain level of aggressive cash flow from the North America pet division, and the market simply isn't delivering it.
Man. And it wasn't just that one massive $1.5 billion charge, was it?
No, the bleeding continue. They also took $302.9 million in impairment charges, specifically for pet brands like Nudges and True Chews, as well as their Uncle Toby's brand.
Wow.
Yeah, and on top of all that, they recorded a $1.03 billion valuation loss related to the planned sale of their Brazil business.
That is a lot of write-downs.
It is. When you add all those paper losses up, it absolutely crushes the reported operating profit. The cash hasn't left the building today, but the future cash they were banking on is gone. It is a harsh acknowledgement of diminished expectations.
Here's where it gets really interesting. Because the massive write-downs in the pet division naturally lead to a paradox in General Mills' overall strategy.
Right.
We just established that they took a $1.5 billion hit because their pet division is severely underperforming their original expectations. Yet their solution this year was to actively buy more pet brands while selling off traditional human food segments.
It is a striking juxtaposition. On the human food side, they actually sold their United States yogurt business to Group Lactalis for nearly $1.8 billion in cash.
$1.8 billion just for yogurt.
Yeah, and that transaction actually resulted in a massive $1.049 billion pre-tax gain for them this year. And if you recall, they had already sold off their Canada yogurt business the year before. So they are fully exiting the yogurt market in North America.
And with that $1.8 billion in cash from yogurt, what do? They turn around and acquire Whitebridge pet brands for over $1.4 billion.
Yep.
I mean, I have to challenge the logic here. Wait, so they took a $1.5 billion hit because their current pet division isn't meeting expectations, but their solution is to dump a massive dietary staple like yogurt to buy another pet brand.
I know, it seems counterintuitive.
Isn't that like buying a new house while the roof on your current one is caving in? Like a farmer realizing their current wheat field is drying up, so instead of fixing the irrigation, they take whatever cash they have left to buy an orchard on the same dry land? Why double down on pets when you just took a bath on them?
Okay, the farmer analogy is good, but let's tweak it a bit. They aren't buying an orchard on the same dry land. They are reallocating their capital to where the soil is actually fundamentally different.
Okay, how so?
If we dig into the segment data, the logic of this portfolio reshaping becomes clear. First, you have to look at the ceiling for growth and the nature of the product itself. The yogurt market in North America is highly, highly saturated.
For sure. The Greek yogurt wars are basically over, and everyone has their established territory.
Exactly. Plus, yogurt requires a complicated, expensive refrigerated supply chain, and it's brutally competitive to secure supermarket shelf space. It is very hard to squeeze out higher margins there.
Right.
But premium pet food, like the Whitebridge assets and their existing Blue Buffalo brand that offers a much higher growth ceiling. The humanization of pets means people are willing to spend disproportionately on high-quality, highly engineered food for their animals. And a lot of that product doesn't require refrigeration.
Let me guess. People will keep buying premium dog food even when they are cutting back on their own groceries.
That is exactly what the data supports. Let's look at their segments. North America Retail, which is human food, is still their absolute juggernaut. It makes up 57% of their total consolidated sales.
Over half. Wow.
Yeah, but its net sales dropped 11% this year, largely driven by shrinking volume. People are just buying fewer boxes. Meanwhile, the North America Pet segment, which is about 12% of their total sales, actually saw a 6% net sales increase.
Wait, hold on. If they had a 6% sales increase in pets, why did they take the $1.5 billion impairment?
Because the initial projections when they bought those pet companies assumed massive double-digit pandemic-era growth would just continue forever.
Oh, okay.
The growth cooled down to a more realistic 6%. It's still growing, just not at the sky-high rate they originally paid for. Furthermore, that 6% increase was largely driven by favorable price realization.
Meaning they could successfully charge more per bag.
Exactly. Favorable pricing and the new Whitebridge acquisition rather than just organic volume growth. But it proves the central thesis: they still have pricing power in the pet aisle that they are entirely losing in the human cereal aisle.
So they are trading a stagnant human food market where they have to fight for pennies for a pet market where consumers will actually still tolerate price hikes.
You nailed it.
That actually sets up the macroeconomic picture perfectly.
Yeah.
Because to understand why human retail volume is shrinking so much,
Yeah.
I mean, an 11% sales drop in your biggest division is an earthquake for a company this size. We have to look at the pressures General Mills explicitly names in this 10K document. The consumer is squeezed dry, and the retailers hold all the cards.
The 10K doesn't mince words about it either. They cite weak consumer sentiment, heightened uncertainty, and significant volatility weighing heavily on category growth. This is leading to what they call a slower pace and higher cost of volume recovery.
Meaning consumers are buying less, and getting them to buy more again is proving to be incredibly expensive. You can't just put a product on the shelf anymore. You have to run expensive promotions, offer deep discounts, and spend heavily on marketing just to get them to pick up the box.
Exactly. And while it costs more to sell the food, it also costs General Mills more to make it in the first place. Input cost inflation hit 4% globally for the second year in a row.
Ouch.
Yeah, so the raw ingredients, the packaging, the energy required to run the factories, it all costs 4% more than it did last year. And last year already cost 4% more than the year before.
That compounds so fast.
It really does. If we connect this to the bigger picture, this is where General Mills relies heavily on a core internal strategy they call holistic margin management, or HMM.
HMM, right.
When your costs go up 4% globally, you really only have two choices. You raise prices for the consumer at the store, or you find savings internally to offset the hit. Through HMM, General Mills actually managed to generate savings equivalent to 5% of their cost of goods sold this year.
Okay, we hear phrases like holistic margin management all the time in these corporate filings, but what does that actually look like in the physical world? You don't just find 5% of your manufacturing costs in the couch cushions.
No, you don't. It looks like brutal microscopic efficiency. It means reformulating a product so the manufacturing line can run 10% faster. It means thinning out the cardboard on the cereal boxes by a fraction of a millimeter to save on packaging and shipping weight.
Yeah.
It means consolidating trucking routes so you are never shipping empty space.
Wow.
They are wringing every possible penny out of their supply chain to offset that relentless 4% inflation because they know they've hit a hard ceiling on how much more the consumer is willing to pay.
And there is a massive reason they can't just keep raising prices.
No.
This is a statistic that genuinely stopped me in my tracks when I read the filing. It's the Walmart factor.
Oh, yes.
According to this 10K, Walmart accounts for a staggering 22% of General Mills' total consolidated net sales globally. And if you just isolate their North America retail segment, their biggest division, Walmart, accounts for 31% of their net sales.
It's huge.
No other customer on earth even hits the 10% mark.
It is an incredible concentration of retail power in Bentonville, Arkansas.
I mean, if one single customer makes up nearly a third of your main division, you aren't really selling to consumers anymore. You're essentially manufacturing for Walmart. I want you, the listener, to picture this dynamic. A General Mills executive walks into a vendor meeting at Walmart. How much pricing power can General Mills really have against inflation when that one single boss dictates a third of their revenue?
Very little.
Right. If Walmart says, we aren't accepting any more price hikes on Cheerios this year, General Mills has to listen, don't they?
They absolutely have to listen. When 31% of your domestic retail revenue is tied to one buyer, that buyer possesses immense leverage over your corporate margins. Walmart's entire business model is famously focused on keeping prices low for their shoppers. Exactly.
So when General Mills faces that 4% input inflation and tries to pass it along, Walmart pushes back incredibly hard.
Which forces General Mills to look inward for that HMM savings we were just talking about.
Correct. They can't rely on their pricing power the way they did in the past. In fact, if we look at a metric called organic net price realization and mix, which essentially measures their ability to get consumers to pay more for the exact same volume of food, or to successfully steer them toward higher margin items, That metric for North America retail was down 2 points this year.
Down 2 points.
Yeah. The era of just passively passing the cost onto the consumer is over. The consumer's exhausted, and Walmart is holding the line.
So what does this all mean? We have a 160-year-old giant facing down Walmart's immense leverage, absorbing 4% input inflation, managing massive pet impairments, and trying to woo a hesitant consumer who is frankly just tired of paying $7 or $8 for a box of cereal. How exactly do they plan to turn this massive ship around in fiscal 2027? They are leaning heavily into what they call their accelerate strategy. And a key buzzword peppered throughout this 10K is brand remarkability.
Brand remarkability.
Yes. For 2027, they have explicitly stated that their price investments are completed. That is corporate speak for, we're done raising prices for now. Instead, they are pivoting entirely to product innovation to drive volume and sales.
But what does that innovation actually look like on the shelf?
They're focusing heavily on adding what they call better-for-you benefits. We are talking about fortifying legacy products with extra protein, adding fiber, introducing bold or spicy new flavor profiles, and creating products centered around permissible indulgence.
Okay, I see.
The strategic logic is pretty simple. If you can't justify raising the price on a standard box of regular cereal because Walmart will push back, you reformulate it. You make it high protein, you slap a functional health label on it, and suddenly you can command a premium price point for a completely new product tier.
Okay, they use the phrase brand remarkability and talk about adding protein and bold flavors to legacy brands. But honestly, I have to push back here on behalf of a listener.
Okay, go for it.
Is adding a few grams of extra fiber to a cereal box or making a spicy version of a snack really enough of a profound innovation to move the needle on an $18 billion company? Or is this just, putting a fresh coat of paint on a house that has a shrinking foundation?
This raises an important question, and it highlights the exact tightrope General Mills is walking right now. Because achieving that remarkability isn't free.
Right.
Research and development, new packaging, marketing, a new flavor profile, it all requires massive capital. And since they can't easily raise prices to fund it, they are funding this innovation through severe structural cuts.
The restructuring charges.
Yes. In the 10K, they detail a new multi-year organizational initiative designed to increase the competitiveness of their supply chain. This isn't just tweaking the cardboard thickness anymore. This is expected to cost $101 million in restructuring charges this year alone.
Wow. $101 million.
And in the physical world, that $101 million translates to asset write-offs, shutting down outdated manufacturing lines, and severance packages for employees. They are cutting deep into their operational muscle, letting people go, and closing facilities just to free up the cash needed to invent and market these high-protein snacks.
And they have a massive target for those ongoing savings, right? Like they aren't just cutting $101 million and calling it a day.
Not at all. They're preparing for yet another 4% to 5% of input cost inflation in 2027. To offset that inflation and to continue funding this product innovation, they are aiming to generate at least $750 million in total savings from HMM and this global transformation initiative next year alone.
$750 million.
Yes. Wrung right out of their supply chain.
And they're trying to pull off that massive cost-saving initiative while facing a built-in calendar disadvantage, too.
Yes, the 53-week year lapping. Fiscal 2026 for General Mills happened to contain 53 weeks due to the way their accounting calendar falls. Fiscal 2027 will return to a standard 52-week year. That means they instantly lose an entire week of sales volume compared to the year prior. They estimate lapping that 53rd week will represent a 9-point headwind on their operating profit next year. It is a mathematical handicap basically built into their projections.
I want to pause and just summarize this reality for a second. They take a $1.5 billion impairment on their pet division. They are aggressively restructuring the supply chain and paying out severance. They are losing human food volume, facing another 4% in inflation, and going into a year with one less week of sales.
That's a lot.
It is. Yet, despite all of that pressure, I noticed they still prioritized Wall Street. In fiscal 2026, they returned a massive amount of cash to shareholders, $1.315 billion in dividends, and exactly $500 million in share repurchases. Over $1.8 billion handed back to investors while the house is being aggressively remodeled.
It reveals the core nature of a legacy consumer staple stock. These companies are ultimately cash generation machines. Even in a down year with massive accounting impairments, their free cash flow was $1.6 billion.
That's incredible.
Right. And for a company like General Mills, Maintaining that dividend isn't optional, it is the primary reason many investors hold the stock. If they cut the dividend to fund more pet acquisitions, institutional investors would flee.
So they have to pay out.
Exactly. So they must maintain that shareholder return, which means the pressure to execute that $750 million holistic margin management plan is absolute. If they can't wring that money out of the supply chain, the math simply stops working.
So bringing this all together for you, the listener, the next time you walk down the grocery aisle and you notice a new high-protein label on a familiar box of snacks, or you see the price of a premium dog food brand holding steady while the traditional cereal goes on deep discount, you aren't just observing random marketing choices.
Not at all.
You are witnessing the direct physical result of these exact boardroom strategies. You are seeing holistic margin management, cost-saving measures, the massive leverage of Walmart, and the desperate push for brand remarkability playing out right there on the shelf.
It really is a profound shift in the industry. And, it leaves you with a final thought to mull over as you navigate those aisles. We are watching General Mills rapidly shed traditional, massive food staples like their North American yogurt business.
Right.
At the exact same time, they're aggressively expanding into functional foods, fortifying with protein and fiber, and heavily acquiring premium pet care brands.
Yeah.
Are we approaching a future where legacy food companies transition entirely into health, wellness, and pet engineering corporations? We might soon see a world where traditional basic cereals and snacks are treated merely as loss leaders, existing only to maintain crucial retail shelf space for their highly engineered, much higher margin wellness and pet products.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.